Very warm good morning, members. I welcome you all for this intensive workshop on New Income Tax Act 2025. And now, may I request Chairman of Bangalore Branch, CA Manjunath M. Hallur, to escort the today's speaker onto dais and welcome him with a floral bouquet. Thank you, Chairman, sir. It's my privilege and honor to introduce our first session speaker, CA Narendra Kumar. CA Narendra Kumar Jain is a commerce graduate, fellow chartered accountant, company secretary, and law graduate. Currently practicing before the Karnataka High Court and Income Tax Appellate Tribunal. With over 20 years of experience in tax litigation, he advised on income tax, transfer pricing, corporate tax, and international taxation. An award-winning scholar, he has authored and co-authored several reputed books, including workshop on transfer pricing, digital commerce taxation, permanent establishment, and modern tax assessments, and has contributed to the revision of Sampath Iyengar laws of income tax. A regular speaker at professional forums, he has taught direct tax and international taxation to CA final students for many years. He has deposed before the Lok Sabha Election Committee on New Income Tax Bill 2025, and he is India's country reporter for the IFA World Congress 2025. He currently serves as a Vice President of IFA India branch for the term 2025 to 2027. He was Chairman of IFA Bangalore subchapter for the year 2023 to 2025, and currently he is Joint Secretary for the Bangalore ITAT Bar Association. With this brief introduction, I present before you CA Narendra Kumar Jain. Over to you, sir.
Good morning. Respected seniors in profession, respected Chairman, Bangalore branch, and professional colleagues. It's a privilege to be here for this session on New Income Tax Act 2025 and to deal with the provisions related to transfer pricing and GAR. The two chapters which were there, chapter 10 and chapter 10A under the 1961 Act, which have been incorporated in a very similar fashion in the 25 Act. Now, as we all have realized, and possibly you would have seen in last few sessions, that the Income Tax Act 25 is more like a missed opportunity. What changes we could have brought in have maybe the government thought to just maintain the similarity. And again, you will find that even in these two chapters, we don't see much of a changes. There are tweaks here and there, some creating problem for the assessees. But in terms of maintaining the flow of provisions, they have remained same. That has been true to the most of the provisions in the Income Tax Act 25. Now, when the original bill came, the draft bill had come, the bill had many issues. And between the bill to the act, a lot of corrections in the provisions have gone through. Select Committee has given its report, and there's a good amount of discussion on various issues in the Select Committee report in terms of what suggestions have come, what they have accepted, what is the department's view on the suggestions. From the bill to the act, the draft is much better. The act is, in terms of errors of drafting, cross-referencing, inelegance in drafting, much of those issues are resolved. But what it has also done is it has brought the 25 Act more closer to 61. So that is why we say 25 Act is more like a missed opportunity. But we being professionals have no choice but to still study what are the new provisions and look at what are the changes that are there. But there is a still opportunity with the government because we still have to have a rules. The rules are supposed to come in the month of January along with the forms possibly. And there is an opportunity to weed out a lot of unnecessary rules and forms. There are quite a lot of forms today which can be just done away with. And hopefully when they look at the rules again, they will think about it. So if you take a form for say form 67, which has resulted in thousands and thousands of cases, the details of foreign tax credit are easily available in the ITR. Why you really require another additional form? And if someone doesn't file that form, you disallow the foreign tax credit. You have form 10, and you have numerous cases today that there is a delay in filing form 10, we are creating problem, adding that to the taxation. Most of the details of form 10 are available in ITR. Why you really require a different form? So this way today still, if we want to really reduce the compliances, we need to at least now relook at the rules and forms that whether we can do that. We can reduce that. Either that much of complications can reduce, that much of litigation can reduce. Hopefully some good sense will prevail and they will weed out unnecessary rules and forms. The unfortunate part of the whole exercise has been the KPI, key performance indicator of people who drafted the law, was how much words you are going to reduce and how much sections you are going to reduce. Whereas the KPI should have been how much of complications you are going to reduce, how much of compliance you are going to reduce, which is not even talked of in last 6 to 8 months of the new act coming into picture. Now, given this background, let's try and look at what the transfer pricing provisions have in store. There are certain key changes. We will try and focus on those key changes and also brush around or go around the entire chapter to say what it really has in store. But with a caveat that most of the computation provisions in transfer pricing or even the procedural provisions in GAR, they all come in the rules. Because the entire computation part, say the methods are given in the act, but when I come to the computation of the arm's length price, it naturally was in rule 10B old, 10B, 10C, 10CA. Now those are not yet prescribed. So as I said, there is still an opportunity to improve those and bring about the, at least address the major issues that concerns the professionals. So we don't have them before us, so we'll have to just focus on what is there in the act. Now, chapter 10, section 92 started with, was the charging section sort of thing for the transfer pricing provisions, and it provided that any income arising from international transaction shall be computed having regard to arm's length price. The same sense has been continued in section 161 of the new act, which is, so the 92(1) becomes 161 in the new act, only with a small tweak. Now, earlier the SDT was coming in the subsequent subsection. They bring in that also in subsection 1, and they now provide that income arising from international transaction or specified domestic transaction shall be determined having regard to arm's length price. Earlier it was shall be computed having regard to arm's length price. Now it is shall be determined having regard to arm's length price. In a sense, not a major change. The computation has been replaced by the word determination. Computation was more elegant because computation is what assessee does. Determination is what the assessing officer does. He determines the total income. I compute the total income. I as an assessee compute the total income. Given that the first burden of transfer pricing in terms of computation of arm's length price was on the assessee, and also it has always been held that the transfer pricing provisions are computation provisions. They are not charging provisions. So if an income is exempt, you really do not have to compute the arm's length price of that, right? What you really do is the charge is still there. The income is taxable under the charging provisions, maybe 4, 5, 9, 28, whatever it could be. But the computation part of it always came in the transfer pricing. So the 161.1 or the 92.1 said that it will be computed having regard to arm's length price. The change in terminology says shall be determined having regard to arm's length price. At this stage, I do not visualize any complications because of that, but it is something which has been changed. Then there was an explanation to 92.1 which said that, now that explanation, so the transfer pricing provisions came in 2001 and then 2002. There was an explanation added because the one subsection 1 only provided that it will be income shall be computed. So a doubt was raised what happens to expenses, what happens to allowances, whether those also should be computed having regard to arm's length price. So an explanation was added in this next year saying that any expense or allowance also shall be computed having regard to arm's length price. Same now, that explanation to 92.1 becomes a subsection 2. Then there was subsection 2, 92.2, which has become 161.3. Now this dealt with the cost contribution arrangements. Now the terminology here remains same, the language remains same, just they have split it up into 2 clauses to make it simpler reading, but the meaning it conveys remains same. What it provides is that if there is any allocation or apportionment of any expense, or there is a contribution towards any cost. So allocation of expense, contribution of any cost which in relates to benefit, service or facility, that allocation to expense or that contribution to the cost should be as per arm's length principles. So that remains same. Then the 92.3 was providing that the transfer pricing is a one-way street. That means it is only revenue favoring. In the transfer pricing, you cannot make an assessee favoring adjustment. Suppose I make a sale at 100 rupees to my associated enterprise and the actual price is 95, I cannot reduce my total income by 5 rupees. Because if it is other way around, I have sold at 100 and the price, arm's length price is 110, total income increases by 10 rupees, right? But you can't do a reverse, you can't reduce the taxable income under transfer pricing. That provision came in 92.3, the old one, and the new 161.4. 161.4 again uses the same terminology, same language, that if the transfer pricing provisions have an effect of reducing income or increasing loss, then the transfer pricing provision should not be given effect to. So you compare the transaction value in your book and has computed as per the arm's length principles, and if it is resulting in a loss, then you really do not, or resulting in a revenue loss, or that means the reduction of in total income or increase of a loss, then you really do not give effect to those mechanism or those provisions. So far so good. Then we had 92A, which is the definition of associated enterprise. Similar provision is there in section 162. Now, there was a huge debate on this particular section. What this section really provides. First, we need to understand what 92A provides, and there is a drastic change in this particular provision. So, we need to understand what is the change. So, currently the 92A has 2 subsections, subsection 1 and subsection 2. Both these sections define what is an associated enterprise. Subsection 1 provides that it's a general prescription, and subsection 2 is a deeming prescription. That's what we mean by deemed associated enterprise. So subsection 1 provides that, in that there are 2 clauses. Clause A, if in one enterprise participates in management, capital or control of other enterprise, then both of them are associated enterprise. To give an example, A participates in management, capital or control of B, then A and B are associated enterprise. This is clause A, currently 92A 1A. Then there is 92 1A 1B, which says that if A participates in management capital control of two enterprises. So there is a common person. So A participates in B, A also participates in C. So B and C become associated enterprise. So the clause here provided for A's relationship with B and A's relationship with C, and clause B provided the relationship between B and C. Now it can go a couple of layers down because the words used were directly or indirectly, right? Now again, when in 2001 it was inserted, this was the first subsection. Now if you notice in first subsection, there is no threshold of how much one should participate. My participation should be 1% or it should be 30% or 50% or 70%. That is not given in subsection 1. But subsection 2 listed out items A to M. Subsection 2, 92A2 listed out items A to M. For example, 92A2 clause A provided that if you hold 26% of voting rights, so if A holds 26% of voting rights, 26 or more, of B, A and B are associated enterprise. This is what clause A provided. Now, the question was, there is a subsection 1, there is a subsection 2. Are they interlinked? Should we read them together? Because subsection 2 does not provide provides a 26% threshold, whereas subsection 1 does not provide a threshold. So if someone holds 2%, 5% or 10% or 12%, is he still an associated enterprise? What do you mean by participation in capital control or management? In 2002, there was an amendment made to subsection 2. What amendment was made is, they linked both subsections 1 and subsection 2. In the opening paragraph or opening limb of subsection 2, the words were added, for the purpose of subsection 1, one enterprise shall be deemed to be an associated enterprise of other enterprise, namely. So, by adding the words for the purpose of subsection 1 in subsection 2, I am talking of old Act 92A2. In the beginning, they added the words for the purpose of subsection 1. So, what it meant is that always these two sections have to be read together because 2's opening limbs link it back to 1. And for the purpose of subsection 1. Now, the board also clarified in its memorandum explaining provisions of the Finance Act 2002 that if you do not satisfy the conditions of subsection 2, then you are not an associated enterprise. So, I may be holding say 21% of voting power, but in subsection 2 the limit was 26%. Therefore, I am not an associated enterprise. Even though I am participating in capital, the general prescription of 1 was satisfied. The same interpretation was given by two decisions, one Gujarat High Court Veer Gems, Karnataka High Court Page Industries, wherein they clarified that these two have to be read together. And if you do not satisfy the conditions of subsection 2, 92A2, in that situation, there is no A relationship that has triggered. You cannot go by general prescription of 92A1. Now, when the bill came, originally in March, they replaced the words for the purpose of subsection 1 with the words without affecting the generality of provisions of subsection 1. So if you see, it was for the purpose of subsection 1. Now those words become without affecting the generality of subsection 1. That means they said 1 is anyway there, 2 is also there. Now, lot of objections was raised against this, which are documented in the select committee report. A good amount of almost 10-12 pages discussion is there on why this change is there. The assessors submitted that if you make subsection 1 and subsection 2 independent, then we will never be able to know who is an associated enterprise. Because participation in capital, if you do not have a threshold limit, either 1%, if I hold 1 share of Reliance Industry, I still have 1 vote. I may not participating in the voting power, right? So this problem, because of this problem, a lot of objections was raised that existing language should be maintained. And the revenue responds to that. They respond that the change is to bring certainty. the change is to bring certainty, because the decisions of high courts have not understood what we wanted, forgetting that they themselves had issued a circular which said that subsection 2 should be satisfied and subsection 1 is, otherwise subsection 1 will not be attracted. They stick on to their argument that this change is proper. The final conclusion of the committee, select committee on this change is that no, what revenue is saying is not correct. What assessees are saying, maintain the same language. They said, please maintain the same language. However, the parliament in its wisdom, or the revenue department in its wisdom, has thought it to change it further. And how they change it? Look at the way they have changed it. Now, both the subsections are collapsed into one subsection. Both the subsections are collapsed into one subsection. The two, so if you see what I explained, that 92(1) had two clauses A and B, and then 92(a)(2) had two clauses, first two clauses A and B. After that we had C to M. But the two clauses of 92(a)(1) and two clauses of 92(a)(2). First two clauses of 92(a)(2), clause A and clause B, deals with the voting power, 26% voting power, right? Now that four clauses are collapsed into one clause, clause A. Now what it does is, if you see this, it says, for the purpose of this chapter, the expression associated enterprise in relation to another enterprise means an enterprise. Means an enterprise. So far so good, not an issue. Okay. The deeming fiction which was there in 92(a)(2) is removed. There is no deeming fiction anymore. Clause A. Clause A basically combines four clauses of the old act. Means an enterprise which participates directly or indirectly through one or more intermediaries in the management, control, capital of other enterprise in the following manner. So what is participation of one enterprise in the other enterprise? In our example, A into B, participation in management, capital, control of A into B, that has been defined in the following manner. And what are those following manner? Clause 1, clause 2, clause 3, right? With me up to this, right? Now look at clause 1. Now don't forget what the main limb says. Main limb says which participates. So if you read it with the enterprise which participates directly, indirectly through or one or more intermediaries in the other enterprise. So in the chart on the previous slide, there were two, A into B, A into C, and B and C. We are talking of A to B, because the main limb of clause A only says when one enterprise participates in other enterprise, right? Now that relationship of A to B is in the following manner. What is that following manner? Clauses 1, clauses 2, clauses 3. Clause 1, 2, 3. I'll go to 2 and 3 first, then I'll come to 1, because it makes it easier to understand. First, take the clause 2 here. One enterprise holds at any time during the tax year, directly, indirectly, shares carrying not less than 26% of voting power in the other enterprise. This is almost a copy paste of 92(a)(2) clause A, old act 61. 92(a)(2) clause A, okay, which provided 26% of voting power, comes up in this clause 2, subclause 2, with a change that it can be at any time during the previous year. Now this is not a change which comes in the 25 Act, it was always there in the 61 Act. Now 61 Act worded it differently. The words at any time during the previous year were on the main limb. So 92(a)(2) read that for the purpose of subsection 1, one enterprise shall be deemed to be an associated enterprise of the other enterprise if at any time during the previous year. So the words if at any time during the previous year applied to all clauses A to M. Applied to all clauses A to M. Unlike now, where it applies only to two clauses related to voting power. So to that extent, it is a favorable change, because under the old law, if it has to be at any time during the previous year, how do I apply this test to say purchase of material? How do I apply this test for sale of goods. How do I apply this test? So at any time previous year, you could have applied for voting power, possibly you could have applied to board of directors. But if I have to calculate the ratio of loan, how do I apply it on a daily basis? I don't draw my balance sheet on a daily basis. So that was a problem which was there under the old law. So at least in the current 25 Act, they have said at any time previous year is applicable only to voting power and not to other clauses. So that is a favorable change. So second clause talks of A into B, 26% of voting power, 26% or more. Now look at clause 3, which is clause 92A to B, becomes clause subclause 3 here. Any person or enterprise holds at any time during the tax year, directly or indirectly, shares carrying not less than 26% of voting power each of such enterprise. So in my earlier slide, there were A holding in B, A holding in C. Then we are talking of relationship of B and C. This subclause 3 now refers to that kind of a situation where it provides that if A holds 26% or more directly, indirectly in B, A holds 26% or more in C, then B and C become associated enterprise. Clear? Now this doesn't, and now come back to clause A, and then I'll explain the anomaly. Now clause 1, not A. One or more person who participates directly, indirectly or through one or more intermediaries in the management or control or capital or more intermediaries, capital of one enterprise also participates directly, indirectly through one or more intermediaries in the management capital control of the other enterprise. Basically what it's trying to say is A participates in management capital control of B, A participates in management capital control of C, then B and C are associated enterprise. But if you look at clause A, no percentage is specified. Clause 1, no percentage is specified. The clauses 2 and 3 gives us 26%. The 1 doesn't give us any percentage, right? Now, when 1 doesn't give us any percentage, how do we understand this? Given that there is no percentage, can a small percentage also now trigger an associated enterprise relationship? Can it also trigger an AE relationship, right? There is a complete mismatch between the main clause and the subclauses. The main clause talks of relationship between A and B. The subclauses talk of relationship between B and C. Now the relationship between A and B shall be following, but when we come down it talks of B and C. It doesn't even talk of A and B except clause 2. So very bad drafting and completely missed the point that why these clauses were there in the statute. But from a perspective of the assessee, what do we do now today? When we sign a 3CB say in next years, because there is no percentage specified in 162(1)(a)(1), whether a smaller holding also will trigger a relationship, that would be an issue which will arise. There is no clarity on this aspect. The board's reply, the revenue authorities reply to select committee, before select committee, which are documented in select committee, they very clearly said we want to have certainty, and that certainty so that the assessees can file the form 3CEB properly, right? That is a certainty they said we want to have. But the changes do not reflect that certainty. Possibly we take some recourse from the select committees, the revenue authorities reply to the select committee, and possibly try to understand that it should not change from 61 Act. In case the equity holding at least is less than 26%, it should not trigger. But that could be our understanding today. Not necessarily the assessing officers behave in the same fashion. Because we already have cases under the old 92A, for example, which also continues in the 25 Act. When you do a sale to a third party, and price and terms of condition of sales are determined by that other party, there is no percentage specified that what should be the percentage of sale that you are making to one party. In case of purchase of raw material, they prescribe 90%. That if you purchase 90% from same party, then you are associated enterprise. But when it comes to sale, they have not prescribed as percentage of a sale. Now, how did the assessing officers behave? In Hospira's case, by Chennai tribunal, the assessing officer took a view that 20% is good. The tribunal upheld 20%. There was another case where the 5% sales and 6% sales were taken as associated enterprise. So if I'm selling my distributor to 5%, my total sales is 100, 5%, 5 rupees sold to one distributor, 6 rupees sold to another distributor. The assessing officers took a view that this results in deemed international transaction. This results in a AE relationship. Now, if someone starts taking a view that 5%, 6% of shareholding, also voting power also is an AE relationship, which falls in clause 1, where no percentage is specified, then there could be problems. Then there will surely be a problem, because clause 1 does not specify what is the minimum threshold of voting power that should be there when we are talking of relationship B2C. Another way to look at it is, this is completely out of place. Clause 1 is completely out of place, because when the main A, clause 1 which is subclause to the A, and A talks of A and B, how can 1 talk of B and C, right? But anyway, those are matters which will have to be debated, which will have to be taken in litigation, and it's the act in the beginning itself is leaving so much of room for confusion that we don't know what's going to happen in future. Apart from this, the other clauses in 92A2, clauses C to M, are replicated in clauses in 162, clauses B to N. The same two way they are coming. The clause related to loan, which is there, that if one enterprise has given more than 51% of book value of loan, it becomes associated enterprise. Guarantee, if someone has given a financial guarantee more than 10% of total borrowings, the AE relationship is triggered. Clause D and E relating to board of directors, that half of board of directors are appointed by one person, or one or more executive directors, managing directors appointed by the one person, then both the person who is appointing and the company in which they are appointed, they will be an associated enterprise. Those clauses remain same. Clause F dealing with the manufacturing. So if I'm doing a manufacturing activity which is completely dependent on the IP given by the third party, then I and the IP owner will become associated enterprise. That clause remains same. That is, the wordings are also maintained same. 90% of raw material purchase or consumable purchase from the old act continued in the new act. If I purchase more than 90% of raw material from one party, I and he will become an associated enterprise. In case of sale, as I said, the sale, the no percentage was specified in 61 Act, that how much of my percentage of sale should be to third party to trigger the A relationship. That absence is still continuing in the 25 Act also. Now this was an area where improvements can easily be made. They could have specified a percentage of whatever they thought fit, that you should have 20% sales or 40% sales or 50% sales. Given that there are no sales, we'll have to possibly take some guidance from the tribunal decision in Hospira, which says that if your sale is more than 20% to one party, the A relationship is triggered. So that could be something which will be there. Then clause relating to individual, that one enterprise is controlled by individual, other enterprise is controlled by individual or is relative, then the A relationship trigger, that continues to be same. Firm, AOP, BOI, if someone holds 10% interest, so if he's having more than 10% share of profit or 10% interest in the partnership firm, then the A relationship will be triggered. That clause remains same. Then there is a clause of residual clause, any other relationship of mutual interest has may be prescribed. So under the 61 also nothing was prescribed, and we don't foresee anything coming in the 25 also. So that is a residual clause giving the window or room to the revenue authorities to prescribe any other AE relationship for them to take it in the as an associated enterprise. So this is with respect to the definition of associated enterprise. As I said, the old Act 4 clauses collapsed. First, both subsections 1 and subsection 2 collapsed into one subsection in the new Act. The old law clauses 92A, 1A and 1B and 92A, 2A and 2B, they are all collapsed into one clause A. The problem area will be because the clause, subclause 1 here of A does not give a percentage, that what is a percentage of shareholding or participation in capital control or management is not defined. So there could be window where the revenue authorities could even look at a smaller percentage to create a problem for the assessee. Then we come to 162.2. Now, if we see again the 1961 Act, we had an SDT provision, specified domestic provisions, 92BA. Certain transactions were defined that they are specified domestic transaction. Threshold of 20 crores if it is breached, then the TP provisions became applicable to the specified domestic transactions. Mostly these were in the areas of tax holiday, and if you are claiming any sort of a tax holiday, these provisions were triggered. If you see the form 3CB, there are different parts. One part dealt with international transaction, one part of the form dealt with the specified domestic transactions. Now, the part which dealt with specified domestic transactions, if you have read it very carefully, it said, give the list of associated enterprise. Give the list of associated enterprise. Now, in a specified domestic transaction, there are no associated enterprise as such. Technically, there are no associated enterprise in a specified domestic transaction. There was no definition of associated enterprise for the purpose of specified domestic transaction. But the form still gives us the list of associated enterprise. Now, what were the transactions that got captured under the specified domestic transactions? Basically, the genesis comes from ATIA 8 and ATIA 10 of the 61 Act. That if there is one assessee but two undertakings, one undertaking is a tax holiday undertaking, the other undertaking is a non-tax holiday undertaking, there is their natural inclination to increase the profit of a tax holiday undertaking. One of the simplest rules I learned in my initial days was pay taxes where tax rate is low. Right? If husband and wife are there and wife's tax rate is low or vice versa, you try and increase the income there. Right? Globally, you say that, okay, tax rate is less in Dubai, I will show income there. Or tax rate is less somewhere else, I will show that. Right? So if I have two undertaking, one tax rate is 0 and one tax rate is 25%, there is a natural inclination to increase the profitability of that undertaking. So the ATIA 8 provided that if there is a transaction between an eligible unit and non-eligible unit, the transaction should be as per the arm's length price. Similarly, ATIA 10, that if there is a close connection between one person and other person, and one person is claiming a tax holiday, other person is not claiming a tax holiday, then that business transacted between this closely connected person shall be as per arm's length price, assuming the 20 crore revenue threshold is breached. Now, we didn't know what is close connection. It was not defined anywhere. It is not defined here also today. Okay. So, the relationships that we talked for the purpose of specified domestic transactions were these relationships: eligible undertaking, uneligible undertaking, eligible person, non-eligible person. Now, we had to give this list in the form 3CB without there being a definition of associated enterprise. They never said that these are associated enterprise. What they have done now is they have defined what is an associated enterprise for the purpose of SDT. That comes in 162 subsection 2, that what is an associated enterprise for the purpose of SDT. They do not really do any value addition. If you see the clauses, I mean, their existence or their non-existence doesn't make any change. Their non-existence would have reduced number of words. Someone in the ministry would have claimed that we have less number of words in the new act. Apart from that, they really don't make any change. What it provides? In relation to specified domestic transactions entered by an assessee, associated enterprise shall also include other units, undertakings, businesses of such assessee in respect of transaction referred in section so and so. So unit, undertaking or business becomes an associated enterprise as referred in 122 or 149. These are tax holiday related chapters, chapter 10 of the new act, where you are claiming certain tax holidays. Right? So it just refers back to parent section. Now look at the second one. Any other person referred in 140.13 or 2054 in respect of transaction referred therein. Okay? So these are again referring back to the same old provisions. If you see the last one, what they do here, other units, undertakings, enterprise, business of such assessee or other person referred in 140(13) in respect of a transaction referred to in section 144, or transactions referred in chapter 8 to which of the provisions of 149 or 13 of this act, or 80IA 8 or 80IA 10 of 61 act applies. So now they are talking that even if 80IA 8, 80IA 10 of the old act applies and the person is referred in that, then that becomes an associated enterprise. In the 25 Act, we are just making a reference to 61 Act. And that 61 Act is repealed, is going to be repealed rather. In fact, there are provisions in this Act also where they say how you will compute a deduction for a unit in SEZ. Compute as per section 80 IA so and so of the 1961 Act. When they copy pasted the entire Act in 61, they could have copy pasted that section also in 61. But they don't do that. They expect you to go back to 61 Act, open the 61 Act and read that section in the old Act and compute as per that. This is a kind of elegance that this Act brings in. But anyway, as I said, this really does not define what an associated enterprise is, what a closely connected person is. It only says that unit is an associated enterprise or an undertaking is an associated enterprise. You will see that we move now downwards. That means earlier in the initial years it was thought that an associated enterprise should be a person. Then associated enterprise can be an enterprise. Now associated enterprise can be a unit or undertaking also. Even a small component of a person can be an enterprise. So therefore, between two undertakings of associated enterprise of the same person, the TP provisions could still be applicable. So this is what is provided for defining the associated enterprise for the purpose of specified domestic transactions. Then we have definition of international transactions, old section 92B, new section 163. Now, if you see the 92B, when it originally started, it provided that the international transaction for the purpose of the transfer pricing provisions, so there should be a transaction between two associated enterprise. One should be non-resident. At least one should be non-resident. Both can be non-resident, but at least one should be non-resident. And the transaction should be in the nature of purchase, sale, transfer, lease of tangible property or intangible property. It could be in the nature of lending or borrowing of money. It could be in the nature of provision of services, or it could be any other transaction which has a bearing on income, profit, losses, assets. This was the definition of 92B1, right, in the 61 Act. Then there was an issue which was raised. Multiple issues came up in the initial years of implemented, that if I give a guarantee for a loan taken by my subsidiary, is it an international transaction? So I've given a loan, my subsidiary has taken a loan, I've given a guarantee for that particular loan, right? The question was giving a guarantee, whether it is purchase, sale, lease of tangible property? No. Is it purchase, sale, lease of intangible property? No. Is it lending or borrowing money? I am not lending or borrowing money. I have given a guarantee, so no. Is it a provision of services? It is not a service, it is a contingent liability, so not covered. Is it any other transaction which has impact on assets, income, etc.? It is a liability which may arise in future on the date when I have given. If there is no enforcement of that guarantee, there is no liability. So there is no impact on my asset. The tribunal started taking a view that giving of guarantee is not an international transaction because the conditions of 92B1 are not satisfied. Conditions of 92B1 are not satisfied. Similar issues came up in notional interest, that notional interest on receivables. I make a sale, I have not received the money within time. Now when I don't receive the money within time, and suppose the outstanding due from my associated enterprise is 6 months, right? But I have not received the money 6 months, 9 months, 12 months. The revenue authorities started imputing notional interest on these receivables. The question was raised before the tribunal, especially the Bharti Airtel's case, that it is not an international transaction. How is it an international transaction? Is the sale, the initial sale which I have done of goods, that is no doubt transfer of tangible property. But a receivable, is it a separate transaction? Is it purchase sale of tangible goods? Is it separate sale of intangible? Is it a provision of services? No. Does it have impact on net profit? Profits, incomes, losses, etc.? No. To override these decisions, an amendment was made in 2012. And that amendment was with a retrospective effect from 2001. And 2012, as all we know, had an history of retrospective amendments. The Great Vodafone Amendment versus the TP amendments also were all retrospective amendments. The 915, 916, 917 retrospective amendments were also there in the 2012 budget. Right? Vodafone anyway got away with it, but we are still stuck with it. The amendment, what it provided is, it added two explanations to 92B1. The first explanation listed out that the international transaction shall include these also. So what it did was, it said that if it is a sale of tangible goods, it said that it will also cover sale of tangible property, building, transportation vehicles, machinery, equipment, tools, etc. It is also covered in this. And one of the items, clause C, was added in the explanation. So explanation 1C said capital financing, including advance, including deferred payment, including payment, was all covered in this explanation. The tide started to change after adding of this explanation, and the decision started taking a view that receivable is also a international transaction. Giving guarantee itself is an international transaction. Parallel changes were also made to Form 3CB to provide that guarantee also you have to report separately, interest also you have to report separately. Okay? But still there was one thought of view. The Bharti Airtel's decision, even post 2012, took a view that even after the amendment, the explanation, because it can only explain the main provision, it cannot go beyond the main provision. That is the fundamental rule of an explanation, that it explains the main provision. Given that it cannot go beyond the main provision, therefore, if something doesn't fall in the main provision, it will still not be taxable. So they still took a view that interest on receivable is still not covered within the main limb, because what is receivable? Is it separate from sale? Is it an independent transaction from sale? It is not an independent transaction from sale. Receivable emanate from sale. If I get an advance and then there are two transactions. There are single. The sale price in an independent market scenario will always factor in the receivable period or the advance received, and then only you will set your pricing. Okay? So therefore receivable is not a separate transaction, and therefore still post amendment this will not be applicable. It was added in explanation, and explanation cannot override the main limb, and main limb did not cover the receivable separately. Therefore, it was still a possible argument. Someday we would have argued before the High Court or Supreme Court. Now that changes in 2025 Act. They have collapsed explanation 1 in subsection 1, and the way they have collapsed, the value of international transaction can suddenly double. What they have done, okay? So if you see there, for the purpose of this chapter, the expression international transaction means a transaction between two or more associated enterprise, one of which is necessarily non-resident. No problem up to here. So it's a transaction between two or more associated enterprise. One party should at least be a non-resident. Okay? And includes. So the last phrase of the main limb is and includes. Whereas in the 92B, it was transaction in the nature of. Transaction in the nature of. The words in the nature of have been substituted by includes. Now in the nature of means there are 5 categories of transactions in 92B1. Only those could be international transaction. Nothing more could be international transaction, because that was an exhaustive prescription. Because transaction should be in the nature of. Nature of purchase sale of tangible good property, purchase sale of intangible property, lending borrowing of money, provision of service, or any other transaction which has impact on profits, incomes, etc. Now that gets replaced by and includes. So much of saying that we will maintain consistency between 61 to 25. If you see the select committee report, revenues response to select committee report, very interesting. if someone made a suggestion that the limit should be increased because these limits were set many, many ages back. For example, limit of STT 20 crores set up in 2015. You should increase it for 10 years have lapsed, right? The simple answer is this is a policy change. The committee's mandate is not to go for a policy changes. The committee's mandate is only drafting a same act, maintain consistency. So across the replies, you will find out that they have very clearly said anything which was unsuitable to them, it is a policy change. If someone asks increase the limit of tax audit because it is set up old years back, maintain consistency between certain provisions, it is a policy change we don't do. But when it comes to changes which might be in favor of revenue, those subtle changes, like this is a subtle change, the word in the nature of get replaced by includes. It will have an implication as we go down the line. But those changes are made and those subtle changes are what will create problem. Now it says shall include the following. Now what they have done is the language of explanation they've integrated with the section. The language of changes they've integrated with the section. So the first clause here reads the purchase, sale, transfer, lease, use of tangible property including building, transportation vehicle, machinery, equipment, tools, plant, furniture. So everything which was there in explanation came here. The problem is not with clause A. We would have anyway reported all of this. Unfortunately, I did not put the clause C there. The clause C, capital financing, that is 163(1) clause C. 163 subsection 1 clause C. Capital financing, look at the words they have used in the section and what can it lead to. It says capital financing, lending or borrowing of money including any type of long-term, short-term borrowing, lending or guarantee. Not much of an issue here. Purchase, sale of marketable securities. Third, any type of advance, payment or deferred payment or receivable or any other debt arising in the course of business. So, advance is a transaction, payment is a transaction, receivable is a transaction. Because now these are all part of the main limb. So you make a payment, it is a transaction. You make an advance, it is a transaction. You make a sale, that is a transaction. You have a receivable, that is a transaction. No clarity on what should be reported in Form 3CB. It gets complicated by this amendment. It was no doubt there in 2012 also, the 2012 amendment also. But that at least was in an explanation. We could have still fallen back on the main limb saying that this is not there. So I have not reported this. Now going by the wordings used in 92B, the 163, what should I report? Suppose today we are reporting receivables. We are reporting the year-end balance of receivable. Anyone who has done 3CB will know this. But if I go by this, every receivable is an international transaction. Now I do a sale on 30th of April, 1 crore rupees, I have 1 crore receivable. That 1 crore becomes international transaction, not is what is outstanding on 31st March. So again, we'll all end up with having no clarity on what to report. Unless the rules come up with something which I don't expect them to do, and only the confusion will get further. Now if receivable is, no, the words are any type of advance, payment or deferred payment. Now if a payment is also in transaction, first I pass a journal entry for sales, sales credit receivable debit, then I'll pass an entry receivable payment debit, receivable, I make a payment through bank, so it will go. Now, is the payment also should I report? Should I report the receivable also? Should I report the sales also? Should I report the transaction 3 times? Very unfortunate way of drafting, and given that there will be no clarity, we'll all end up in another round of litigation, unnecessary in all of these. No doubt these are all continuing from the old act, but the drafting in the new act makes it further more complicated and further more indefensible for us to argue that these are not covered in the transactions. And as I said in the beginning, what really is required not to reduce the number of words, but reduce the number of compliances if they really want to simplify the law. And if they really want to do that, at least the rules and forms are there where they can take care of these kind of things and reduce the amount of compliance that all of us have to do. Then the real purpose of having a simplified law will somewhere be seen. So this is on the international transaction. Then the explanation 2 of 92B2, explanation 2 to 92B1, which define intangible property, is a replicated same to sum word by word, has subsection 3 in the new law, 163.3. Before that, we have 163.2 deemed international transaction, which is parallel to 92B2, So as you all know, the current 92B2 provides a definition of deemed international transaction, and that definition of deemed international transaction says that if you are transacting with third party, but the terms of your transactions are in substance determined by your associated enterprise, or determined prior, or there is a prior agreement between the third party and your associated enterprise, then the that becomes a deemed international transaction, and even the TP becomes applicable to that particular transaction. So that continues under the new law also, no change. They're broken up into clauses, but finally it conveys the same meaning, that it will remain same. So these were the changes what have come about in the definition of international transaction. So we saw changes in associated enterprise, changes in the international transaction. Then we move to 164, which is parallel of 92C. 92C currently deals with the computation of arm's length price, but 92C naturally has to be read with the rules, rule 10B, 10C, 10CA. Currently, given that we do not have these rules with us, we don't know what would be the impact of changes, if any, in the rules. So as long as the 92C, the language of 92C vis-a-vis the, before that we need to have 164, which is the definition of specified domestic transaction. 92C is 165. Okay. So 164, which is the definition of specified domestic transactions, old 92BA. So 92BA, whatever there, the transactions which were covered in 92BA between eligible and uneligible undertaking, transactions between eligible undertaking and non-eligible undertaking, transactions between a person claiming any tax holiday or new tax regime of manufacturing entity, SEZ units, all those is a replica of is there in 164. There is no change. So consistency is maintained between 92BA and 164. The limit of 20 crores has also been retained. As I said, there was necessity that at least the limits are periodically increased. This limit was set in 2016. This limit of 20 crores continues in the 25 Act also. They have not changed the limit. They said changing of limit is a policy decision which cannot be done during the select committee discussions. Then we come to 165, which is parallel to 92C, section 165 parallel to section 92C. So the old 92C had various subclauses, subsections. What it really provided was that subsection 1 says that for computing the arm's length price of an international transaction or specified domestic transaction, same shall be determined by selecting most appropriate method out of the following methods. The following methods were comparable uncontrolled price method, resale price method, cost plus method, profit split method, TNM, transactional net margin method. And there was a residual clause that any other method has may be prescribed by the board. Under the power of this residual method, they prescribed rule 10AB, which was what we called as other method. So effectively there were 6 methods. The same terminology, phraseology has been continued in the 25 Act. There is no change there. The 5 methods and the residual power to prescribe something new has been continued under the subsection 165 subsection 1 also. Then the process of selecting the most appropriate method, which should be read with rule 10C, the conditions which were there, that while selecting the most appropriate method, you will have regard to FAR analysis, you will have regard to class of transaction, nature of transaction, class of associated enterprise, and all other relevant factors as may be prescribed. That also remains same in the 165 subsection 2. And it also further provides that the computation should be done as per the rules prescribed. So as I said, we'll have to wait for the rules. Lot of TP provisions are there in the rules. So unless they come about, the rules come about, we really don't know what the computation mechanism with respect to methods is there in the rules. Then subsection 3 of 165, this is parallel to provisos of 192C2. So 92C2 provisos provide for arm's length range. Again, the consistency is maintained, but the main meat of computation will again come in the rules. What it now provides is that if you are computing one price in any method, if you are computing any one price in any method, then, so there was one conflict which was there in these provisos, that we originally had 5% range, and then that 5% was shrunk to 3%. But when the 5% range was there was an issue whether 5% range can be applicable where you have only one comparable transactions. If you have more than one comparable transaction, originally we had arithmetic mean, then it changed to a concept of mean plus median. If you have 6 or more, you have median concept. If you have 5 comparables, up to 5, you have a mean concept, right? But the question whether the range is applicable for a single transaction was disputed, and the assessing officers in the initial years of TP were disallowing it. In the amendment which was made in 2014, they extended the arm's length range concept to single comparable also. They extended it to single comparable also. And that has been retained in 165.2, wherein they have provided that if there is single comparable, you could also have a range concept. Okay? The maximum limit of range could be 3%. That is the max. The government can, by notification, prescribe the lesser percentage of range, which currently stands at 1% for wholesale traders and 3% for others. If you are following the arithmetic mean, in case of median, then it comes in the rule 10 CA. Okay? Given that we still do not have rules, but the prescription of the top maximum 3% remains same in the case of single comparable. And in case of more than one comparable, naturally everything will come in the rule, and the rule possibly will follow the similar line, and it could be remaining same. Then under the old law 92C3 provided 4 circumstances in which the assessing authorities could disturb your computation of arm's length price. The original burden of computing the arm's length price is on the assessee. But if the assessing officer under 92C3 had 4 circumstances, he could have said that I am going to recompute myself. I am going to recompute the arm's length price determined at my end. Now, what was those 4 circumstances? 1, the assessee has not determined the arm's length price properly. The data used is not reliable, or the data is not kept. The TP documentation is not kept, or the computation is kept. The conditions prescribed in 92D, the documents described in 92D are kept but are not furnished. So either your computation is not correct, you don't maintain the documentation, you maintain but don't file, you maintain but that is not reliable, right? So these were 4 circumstances which were there in the 92C3. They continue to be applicable in the same phraseology, again same language used in 165.4. There is no change in the language or circumstances used in 165.4. Okay. Then the other mechanism of issuing notice, giving an opportunity to the assessee, those continue to remain same. There is no change in that particular thing also. There is a very interesting provision of 92C4 in the current law, which says that if your income is enhanced by the assessing officer, then on that enhancement, you don't get any deductions. So if I'm eligible for 10AA or I'm eligible for any other Chapter 6A deduction under the old Act and the parallel provisions in the new Act, so 140 in the new Act, for example, because the 10AA has moved to the deduction section. Currently it is in the exemption section. Under the new law, it has moved to the deduction section. Now, if I am claiming on the enhanced portion, so my original profit was 100, the assessing officer makes it 110. And on that additional 10, whether I'll be eligible for any Chapter 6A deductions, right? If the addition enhancement is happening because of TP provisions, the law very clearly restricted that you will not get the enhancement. What old 92C4 and the new 165.7 provides is that if the enhancement, if the assessing officer has made an enhancement under 165.6 on that enhancement, you will not get any deductions under chapter 8, which are the parallel to chapter 6A or 144, which is parallel to 10AA. So you won't get any deductions on these. So the provision continues, but the problem which was there is not solved. The current provision says that the enhancement, if the assessing officer does, you don't get a deduction. But if you yourself do it, you can claim a deduction. There was a silence. The provision did not cover or did not provide for any of that. So what assessors did was, on the additions, if they made it suo motu in their return of income, or even if it is arising in the APA. So I have then actually done cost plus 12%, but in APA I make it cost plus 17%. So I have 100 crores of cost, I originally billed 112 crores. Now APA says me you additionally offer 5 crores more. Okay? I offer that 5 crores, but on that 5 crores I claim 10AA. And it was permitted by the tribunal, because the restriction in the section only came in if the enhancement was made by the assessing officer. If the assessing himself did the enhancement, the restriction did not come into picture. Okay? So that could have been corrected, which is again missing. The language remains same. Today also, if for some reason you yourselves do an enhancement, on that enhancement, if you are eligible for any tax holiday, possible to claim. There are favorable tribunal decisions on this particular aspect. Okay? That is subsection 7, 165.7. 165.8. 165.8 is a reverse effect. That means, if there is a TP adjustment in the hands of Indian company, suppose you make a royalty payment of 100 crores to your associated enterprise. You do 10% TDS, 10% is taxable in the hands of non-resident, he files his return and offers 100 crores as royalty, 10 crore tax paid, no problem. The assessing officer says, what 100 crores you have paid, you will not get, that is more, that is not arm's length. He makes that 100 crores as 70 crores. So what becomes deductible in your hand is 70 crores. What is taxable in the hands of non-resident? 70 or 100? Still 100. Now can the non-resident say that, look, you yourself said the actual price should be 70, therefore give me a refund back of 3 crore rupees. That would have not been possible, because old 92.3, current 92.4 says that the TP cannot have an effect of reducing income in India or increasing losses in India. And the 92C4 proviso in the old section said that it will not have any effect on other provisions like TDS. You cannot say I have deducted more TDS, give me back 3 crore rupees. You can't do that. Okay? That provision continues even in the new statute also, as it is. That restriction in the new statute continues as it is. This is 92C, old 92C, new 165. Then we have new 166, which is parallel to 92CA. 92CA provided that reference to assessing officer, that under what circumstances a reference can be made to the assessing officer. That was provided in 92CA. 92CA was inserted subsequently. When the Act came in 2001, we did not have a 92CA. But in 2002, they thought that the TP assessment should be done by a specialized wing, and therefore the TP wing was formed, and a specific provision was inserted in the statute that assessing officer will make a reference to the transfer pricing officer if he considers it necessary and expedient to do so, to compute the arm's length price. Okay? So that is how the 92CA came into picture. That continues in 166. The procedure more or less remains same. The things which have led to huge amount of litigation could have been improved but not changed. Okay, for example. So currently what 166 does is subsection 1, reference to the transfer pricing officer. And then also there is a concept of block TP assessment, which was inserted in 25 Finance Act, which was brought in from the 25 Finance Act. I will come to that separately. Okay, but overall the reference remains same. The AO makes a reference to TPO if he considers necessary and expedient to do so. The TPO, with the approval of principal commissioner, he takes the approval, prior approval, makes a reference. The assessing officer, the TPO will then issue a notice, call for information, and pass the order. The order of the TPO is binding on the assessing officer, because they the words used in old 92 CA4, which is 165, 166.6, 166.7, is that the assessing officer shall pass order in conformity with the order of the TPO. The dispute here was originally in 2001, the language in section was in 92 CA4 was the assessing officer shall pass order having regard to the order of the TPO. Having regard to means what? You have regard, you have respect, but don't follow. Not necessary that you should follow. You can have respect, having regard to, give a respect, but you may follow, you may not follow. They realized this problem because the Sony's decision, Delhi High Court, and Aztec's decision, Special Bench, Bangalore Tribunal, said the EO may or follow, may not follow. It is up to him. So they changed it to in conformity with. The EO shall pass the order in conformity with the TP order. So that language continues in the 25 Act also. So TPO's order shall be binding on the EO. And then the normal procedure of draft assessment order will trigger, all that will happen. Now, the time limit issue was there. The time limit issue, which is one of the recently top litigated issues, is that what is the time limit in which the TPO should pass order, and 60 days, so the old 92 CA3A provided that you should pass an order 60 days prior to the it says at any time before 60 days prior to the date on which the period of limitation expires. So if the period of limitation is expiring on, say 31st March, how do you compute 60 days? Should you calculate it from 31st March, or you should leave 31st March and calculate? Because the words used were 60 days prior to the date of limitation. 60 days prior to the date of limitation, right? So the Madras High Court in Pfizer's decision said, because the words used are prior to the date of limitation, you leave 31st March outside and then calculate 60 days. Okay? So when you calculated those 60 days and assessing officers had not factored in this, generally what happened if the due date was 31st March, the department assumed that the last date for the TPO to pass order was 31st January. Without having noticed that February may have 28 days in 3 years, and 1 year it may have 29 days. Plus if you leave the 31st March outside, the last date in many cases become 29 January. Okay? And they would have passed the order in 30 or 31st thing. So Madras High Court in Pfizer's gave a decision that you exclude 31st and then calculate the 60 days. And a lot of orders got time barred on this simple issue. You didn't have to litigate on merit at all. Nowadays, all of us are only finding these kind of issues. Because on merits, no one understands, including the assessee, the consultant, the assessing officer, and the judge. No one understands the subject. So find out the limitation issues. ROCA, DIN is not there, this is not there, and officer has not signed, digital signature is not affixed. The 148 issued on the after the limitation period, that becomes more easy ground. Okay, so this was one of the issues. Now they have tweaked the language but not corrected it. The prior gets replaced by before. Okay, now again debate whether the Pfizer will apply in the new law. Now what the new section says is, where a reference is made under subsection 1, an order under subsection 6, which is the TP order, may be made any time before the expiry, 60 days before the expiry of limitation period. 60 days before the expiry of limitation period, 60 days prior to the limitation period. The prior gets replaced by before. The question would be, again in the new, whether the words prior and before, the replacement of word prior by before, will it carry the same meaning as what the Madras High Court dealt in Pfizer? If it carries the same meaning, again we'll have to say that 31st March has to be excluded, and then you calculate the 60 days time limit. Okay. If they had not used the word before, or the before's placement was before 60 days, that means before 60 days, rather than 60 days before the limitation, the placement of word would have changed, then it would have possibly solved the problem. The way again this language reads, the Pfizer's decision in all probability will still continue to apply. The litigation on this fund will continue to continue in the future also. One of the objectives of 25 Act was we want to reduce litigation. I was told in one of the meetings that we want the act to be so simple that 80% should not come to chartered accountant, which is not going to happen. We should ask the MPs whether they file the return themselves or they come to chartered accountant and file the returns. Right? So the simplicity what we expect doesn't come about in the language. Then comes the block assessment concept in the TP provisions, where you can do an assessment for 3 years, which was inserted in 25. A good amount of suggestions were given on the block assessment concept, and when before the select committee this issue was discussed, was brought in that the current block assessment concept what you have brought in is not serving the purpose. The reply of revenue authorities, you see the revenues reply to the suggestions which have been made before the select committee. They say that the block assessment concept is recently brought in. It has been brought in only 25. The first year is AY 26-27. Still we do not have any experience on this. So therefore no change should be made. Now is it a way to approach the problem? Now when the suggestions have come that this is a problem in the law and this can be corrected in this way, they want first the litigation to come and then solve the problem, and not resolve the problem before the litigation comes. It is like diabetes. You can take insulin, but the question is, can you change the lifestyle so that diabetes doesn't come? Our litigation is like this, that we do not want to resolve it, but we want to have it and then keep on taking insulins so that the pharma companies, here advocates like we, keep on making money. So the block concept remains same. There is a first year of which the assessment is done. Then I can make an application to the assessing officer that you apply the same principle for the subsequent 2 years. The TPO can accept my application and pass an order whether he is accepting my application or not. And subsequently, he will pass orders to the other 2 years in line with the year 1. So and then they have said that we will prescribe the rules how this should be implemented. The rules have still not been prescribed. So we really don't know that what is in store for this block assessment concept. Then we have safe harbor, continues same, no change. Again, as I said, safe harbor is mostly coming in rules. What is the rate of for rules, rate of margin for IT industry or ITS industries or corporate guarantee or interest, all that comes in rules. They continue with the same section 92 CB doesn't deal with that thing. It also doesn't deal here. Then we have APA. Again, more or less the provisions have been retained. So safe harbor will have to wait for the rules to be prescribed. APA also, the procedural aspects are all in the rules. The fundamental core principles of APA have been retained. That means you are going to have it for 5 years. You'll have to file an application. Then there are certain core principles which are defined. And if the APA is entered into, what happens to the assessment in the intervening period? For that purpose also, the provisions which are there in the old act, modified return has to be filed in accordance with the APA. After the modified return, a fresh assessment will be done. All that provisions have been retained cumulatively in the new act also. So these are dealt with in section 168 and 169. The procedural provisions are covered in that also. Then we have section 170. Section 170 deals with secondary adjustment, old 92 CA. Now, if you see the section 92 CA, the secondary adjustment, which triggers if there is a primary adjustment of more than 1 crore rupees. Now, what is a primary adjustment? Primary adjustment is the adjustment which the transfer pricing officer makes or which the assessing officer incorporates in his order. So that is an adjustment which we call it the primary adjustments. That is a difference between the value computed, the transfer price, actual transfer price vis-a-vis the arm's length price. So your actual transfer price is 10 crore rupees, arm's length price is 12 crore rupees, the difference become 2 crore rupees. So this is the primary adjustment which is more than 1 crore rupees. Again, this 1 crore limit was set in 2017. Suggestions were there that increase this limit, but it has not been increased. So if any primary adjustment is more than 1 crore rupees, then the secondary adjustments could be triggering. Okay. And today the 1 crore amount becomes very small. Even in cases, many cases we feel that it is worthwhile to pay the taxes and close the matter. At a practical level, because of secondary adjustments, we are not able to do it. What secondary adjustment provides is that this difference of 2 crores in my example will have to be brought back into India from an associated enterprise who is a non-resident in 5 circumstances. What are these 5 circumstances? 1, you suo moto offer additional transfer pricing adjustment in your return of income. Your assessing officer makes an adjustment, you accept it. Third, you go for an APA, and as per APA, an additional income is offered as per the APA agreement that you have signed. Fourth, safe harbor, you have taken a value in your books, say at 10 crore rupees, as per safe harbor it comes to 12 crore rupees, you offer that 2 crores in your return of income. That is the fourth. Fifth, MAP, mutual agreement procedures under the treaty. The order has been passed, you have gone to the litigation, then the competent authority, the map has been filed by your associated enterprise. The competent authority of India, and say it is Japan, the competent authority of Japan, both have sat together and decided what should be the TP adjustment. So the TPO has made a TP adjustment of 50 crores. The authorities in India and authorities in Japan can sit together and decide that the adjustment should be 10 crore rupees. Okay? Now that is map. So the 5 circumstances, suo moto, safe harbor, APA, map, and assessing officer. So if these 5 circumstances arise, the law provides that the difference should be remitted back to India within the prescribed time, which is 90 days. 90 days of the trigger events. If you do not bring back this into India, it is treated as a deemed loan to your associated enterprise. Suppose I have my AE outside India, A limited, I am in India, B limited, the adjustment of 2 crore is made, and I am accepting these 2 crore rupees today, right? Then my A limited, which is outside India, should remit this money back to India. If it doesn't remit this money back to India, this 2 crore is treated as a loan to my associated enterprise. After initial 90 days, it triggers an interest on this loan. That means every year, suppose the rate of interest is 10%, and I have given 2 crore rupees. 2 crore is the primary adjustment. Then 2% or 10% on this 2 crore rupees, 20 lakh rupees, every year I have to add to my total income. I have to add in perpetuity. It doesn't stop. There is no stop to that. It has to be added in perpetuity. That is option 1. Second option is I remit 18% of this primary adjustment along with surcharge and cess to the government of India, and that day the interest calculation will stop. So if I decide to remit additional taxes, then the secondary adjustment will stop. So this is what the provision provides for. This is what the provision provides for. So today, even if we want, assessing officer makes a small addition of 1 crore or 2 crore rupees, if I have to accept that addition, look at the amount of litigation that comes, amount of tax liability that comes in. First the tax on that primary adjustment plus interest tax penalty. Then you have secondary adjustment 18%, etc. Okay. Now even if you settle this in VSVS, assuming you even settle this in VSVS, they have not said that you can't, the secondary adjustments will not be applicable. That will still be applicable. Even if you settle this in MAP, where 2 competent authorities are sitting and deciding, the secondary adjustment will still be triggered. At a ground level, assessing officers or transfer pricing officers are not actually doing these adjustments in the assessment orders. But suo moto in form 3CD, there is a clause, secondary adjustment as per 92 CA, right? You have to report whether there is any secondary adjustment which is there. None of the clients are reporting. To that extent, there is a non-compliance. We have seen people who are accepting the TP adjustment but not reporting this. So the best way to avoid this is keep filing appeal. The appeals will take 25 years, right? If you lose in tribunal, file to tribunal, high court. If you lose in high court, file to Supreme Court. 25 years will take. No one will even remember that something has happened before that. Records will have been lost in the government, and then no one will know that whether a secondary adjustment has to be done. That is the practical solution to the secondary adjustment. Otherwise, the provisions from 92 CA have been borrowed in 170. The language more or less remains same. 5 situations are same, have been covered in the the new act also, and same mechanism has been given. In terms of rate of interest, in terms of period, in terms of how I have to get the money back, all that came in rules, and possibly the rules will remain same, and that will continue to be applicable. Section 92D of the old act, 171 of the new act, the TP documentation, the local file, TP study, and master file, both conditions have been retained. They will remain same. So the requirement to get TP study, if your threshold is above 1 crore rupees, which is in the old law, then the 1 crore limit comes about in the rules, and hopefully they amend the rules and at least increase 1 crore limit, because 1 crore limit was set in 2001. And they have not increased in last 25 years the limit of doing a TP documentation. So the 3CB is triggered for rupee 1. The TP documentation is triggered for 1 crore transactions. It is a time that this limit is increased if they really want to reduce compliances for small companies. Then you have 172, which is parallel to 92 CA certificate, accountant certificate rather, for the purpose of transfer pricing will continue to apply. The definitions more or less have remained same. The definition of arm's length price, enterprise, permanent establishment, specified date, all of that have continued to remain same from 92F. So those aspects have also remained same. So if you see the TP provisions, this is going to be a major issue in the definition of associated enterprise, and the definition way international transactions definition has been modified. These two could be major triggers in the future also, especially the 92A definition, where the collapsing of 2 subsections into 1, and similarly to 92B also, because subsection 1 and the explanation have been collapsed into 1. So the amount of transactions that can get covered, amount of associated enterprise that can get covered could be greater. So this is on the transfer pricing. Then we move to GAR provisions. That is the second topic which has been given to me. So the chapter 10A, which is chapter 11 here, chapter 10A of the Income Tax Act. There we introduced GAR in 2016. There was a lot of hue and cry about this. Then there was a deferment. Then the committee report came. A lot of inbuilt check and balances through the Shom committee's report were brought in. A good amount of procedural provisions have also been prescribed in terms of how the GAR provision works. So most of the provisions again in relation to GAR have been dealt in the rules. So I assume again that these rules will continue to apply. The fundamental principles remain in the act. Okay. So for example, today the GAR is not applicable if the tax effect is less than 3 crore rupees. Right? But that comes in the rules. It doesn't come in the act. Now, either they may retain that similarly, or either they increase it or reduce it, we don't know. So we can't comment on that part of it. But so those aspects will all have to be taken care in the rules. So same like TP, a lot of GAR procedural provisions all come in the rules. Possibly we'll have to have one more big seminar on the rules once they come, on the rules and forms, but that is for the institute to look into that in maybe in Feb or March. Okay. So apart from that, what we have to see the fundamentals which are coming on section 178 onwards. At least compared to TP, the GAR provisions, there is not much change. The changes are cosmetic, which do not really impact the final output, final interpretation of the section. So to that extent, they have maintained the consistency. GAR has seen traction recently. That means the authorities have started applying GAR in the assessments recently. We have not seen much cases earlier, but recently 2 Telangana High Court cases, and we also seen Hinduja's case recently, where a GAR has been applied. So it's a good probability that they have, has happened with most of the laws. In the initial years, department is slow to adapt them, but once they learn that what the law provides, they start applying across the board in many cases. And GAR is a much more wider impact, much more draconian in terms of what power it goes to the assessing officer. The best part of GAR is there are checks and balances. You have a panel of 3 commissioners and a lot of procedural inbuilt provisions are there. At least to that extent, there might be some safeguards in terms of its implementation. But in terms of gamut of power or width of power which is there with the assessing officer, there is unparalleled. GAR is unparalleled compared to any other provisions. We'll briefly look into this because I need to wind up in next 10-15 minutes. So 178 says that GAR will be applied if an arrangement is declared, arrangement which is entered by an assessee is declared as impermissible avoidance arrangement. Impermissible avoidance arrangement. So if assessee has entered into any arrangement with other parties, that can be declared as impermissible avoidance arrangement. And once it is declared as impermissible avoidance arrangement, the consequences of that will be determined as per chapter 11, which is the GAR provisions. So what happens if there is a declaration under 178 is dealt in the subsequent provisions. Now what is impermissible arrangement? Impermissible avoidance arrangement. 179 gives 4 situations. We call it 4 sins. That means if you commit any of these 4 sins with the objective of having a tax benefit, then you will get caught here. And what are these? That your transaction or your arrangement creates rights, obligation, which no one would create if transacting in arm's length. So if you transact in arm's length, what rights and obligation you create, but you have created something different, that becomes an impermissible avoidance agreement. Results in misuse or abuse of any provisions of the Act. Very thin line, what is use, what is misuse, what is abuse. Very thin line. But this is what it is. You can use it, but you cannot misuse or abuse it. You can use a provision, but you cannot misuse or abuse a provision. So this is the second sin. Third is the transaction or arrangement lacks commercial substance or is deemed to lack a commercial substance. There is a deeming fiction also. But if you do a transaction which lacks commercial substance, then it is impermissible avoidance arrangement, IAA rather. And then you have entered into an arrangement which is not for a bona fide purpose, that no ordinary person would enter into for bona fide purpose. 180 of the new act further elaborates this, that what could be transaction which lacks commercial substance. They give examples like round-tripping finance, you have an accommodating party, and you have transactions which are self-cancelling. At the end result is same, but the transaction's nature is such that it creates a tax benefit. So their transactions are self-cancelling in nature, offsetting or self-cancelling in nature. Okay? And you have a transaction which disguises the source, ownership, control, or it involves the location of an asset or transaction or a place without any substantial commercial purpose. So you are locating an asset, locating an income, locating a person in a particular jurisdiction without any commercial substance. That is another situation which has been considered. Then round-tripping finance is also defined. So these are the aspects which are being covered in the definition. There is no change from the 61 to 25. They were there in 61 also. Good amount of examples and all of this is there in the Shom Committee's report. Those can be referred to if someone come across the GAR case. The main crux of the matter is what can the assessing officer do if the GAR triggers, if the impermissible avoidance arrangement triggers. And that power continues in 181, parallel section 98 of the 61 Act, parallel provision 98 of the 61 Act. What the assessing officer can do is very widely defined. What he can do? He can disregard, combine, recharacterize any step. So I have given gift to A and A has given gift to B, just to avoid a situation where someone is not tracking it. You can avoid that you have given gift to A. You can combine the transactions. Disregard any accommodating party. There's an accommodation entry, someone has provided, there's a party in between who is provided an accommodating party, that can be disregarded. Relocate, reallocate, accrual, receipt, capital, of capital nature or revenue nature. You have taken income in one person, the assessing officer can reallocate it to another person. That can be done. reallocate any expenditure, deduction, relief or rebate. You can change the situs of asset or transaction. You can change the place of residency. You are claiming that the place of residency of a company is in Singapore. Assessing officer can say, I will apply GAR and place of residency is in India. You can look through any transaction, disregard any corporate structure. So these are the powers of the assessing officer, which he can apply. Now, after he has applied these powers, then he can also treat two separate persons as one, or one person as separate persons. Look at the powers. You are two different persons, you can treat it as one. This one person, you can treat it as two. You can disconnect the person, you can join the person. So again, these powers which are there under the GAR provision, extensive. And we are, as I said, the traction of applying the GAR has been recently caught. Recently, we have started seeing the cases where they started applying GAR, which was not there for last 5-7 years. And GAR can be applied in addition to in existing provision. So for a transaction, if transfer pricing is applicable, then GAR should ideally not be applicable, because will you test the same transaction for both transfer pricing and GAR? But the law in 183 and old 100 provides that the GAR can be applied in lieu of or in addition to other provisions. And recently the AP High Court has also held that it can be applied. So case where the existing 94 was applicable, even those transactions they applied the GAR. So that kind of a situation can emerge. The computation, the guidance, the GAR will be applied as per the guidelines and subject to such conditions as may prescribe. So as I said, the board will have to really come out with the guidance and conditions for application of GAR. This again is very similar to what is there in the existing 101 of the current provisions. Existing 101 of the current provisions of the 61 Act, where the guidance is then coming in the rules, and based on the rules, the applicability has to be there. So again, as I said, for TP we'll have to wait for rules, for GAR we'll have to wait for the rules. What is prescribed in the rules could be making a lot of change. The last section in GAR is 184, which gives the definitions. These definitions are again combination which of all of them which are there in 102 of the existing Act. There is not much of a change. And again, these definitions are basically borrowed from different places of the statute. So there is a definition of connected person, which is nothing but the definition of a relative under 48(2)(b). So there is nothing greatly new in those things, but anyway, these are something which are there in the statutes. So we have a definition of arrangement, accommodating party, asset, benefit, connected persons, fund, party, relative, step and tax benefit. How to calculate tax benefit is also given. So all of these basically emanate from the existing 102, have been replicated in the new provisions, and they remain same. There is no change as far as these provisions are contained in the 25 Act. So with this I have concluded my set of provisions of transfer pricing and GAR. Thank you everyone for patient hearing, and as always, I thank Bangalore branch for giving me this opportunity, because coming here and speaking, the preparation helps you to learn a lot. And if there are any questions, maybe a couple of questions we can take, if anyone has any questions or anyone has any input, because this is still a new Act, all of us are learning, and someone might have a different interpretation of something which I have said. Yeah. So if there are no questions, I will hand over to the chairman, sir. Thank you very much.
Thank you, Narendra Kumar, sir. That was really enlightening for all the members here. The new Act, the things they have brought into the play, really wonderful. I request the chairman to please hand over a memento to the speaker. Thank you, sir. Yeah. Members, we'll break for tea for 10 minutes and reassemble here for the next session.